The markets wait for signals, GDP numbers, jobs numbers, and a whole list of indicators. These fluctuate, but in most cases they present a positive view, and so we see growth of the stock market as a result. There are times, however, in history where a market needs some help. In 2008, that was certainly one of those times. Unfortunately, the market broke. Today, they still haven't fixed it. The next time they need to rescue it, they could easily create a hyperinflationary spiral on a global scale. You came here for the truth, so let me unveil that for you. Today we're going to talk about the recession warning that has officially been triggered. I'm going to show you it momentarily out of CNBC. I want to look at what happened in the markets. I want to talk about so many factors today. Stay tuned for a jam-packed episode. This article here is just covering the issues, the trade tensions once again being blamed for the Dow Jones dropping 238 points on the day. The yield on the benchmark 10-year note fell to around 2.26%. It's the lowest level in 19 months. Yields move inversely to prices, and obviously we have seen this trend continuing over and over again. The next downturn could see a radicalization of the policies used during the financial crisis. I have talked about this before, and what we have seen is that the QE model largely was ineffective at actually doing what they said that it would do. They tried to support all of the different markets around, and of course, look at Europe as an example. It didn't work. Now, if we see the United States, obviously they have benefited not just because of quantitative easing, that has been a major support, there's no doubt, but it didn't really work in the way that they said it would. They tried QE1 and it had some positive benefits. They had to do QE2. They said they would never do it, but there they were doing it. They said they would never need to do anything else. They did Operation Twist, and then QE3 came in, and it was actually an unlimited open the tap QE3. It took them way longer than they said it would. The interest rates were rock bottom for the longest period of time. All of this was supposed to be a temporary state. It was just temporary until all the problems were resolved. But here we are today, and everything is simply continuing on. No, they're not necessarily engaging in a QE4 at the time, at least from what we can tell from the outside, any public measures. But when you see all of this and you understand that they even talk about it, that we cannot move at this point because the markets are going to be spooked. We are 10 years out from the crisis and yet still carrying on the issues. When you want QE to work, this happens to be a problem because of what we have seen time and time again. You're trying to print money and then give it to banks, and that, of course, doesn't stimulate the economy. It's a ridiculous policy. All this is an excuse to give money from the central banks printed out of thin air and give it to the elite. This next stage could be something like an MMT. That's what they're suggesting here in this article. Another economic crisis could prompt an even more aggressive response than the last one. The response could be any mix of three approaches: modern monetary theory, negative interest rates, or so-called helicopter money. Such moves could come either due to an economic slowdown or populist political pressure. They are trying to suggest why it's going to happen, but we have to understand that at some point the cycle is going to turn over and we will have an issue that has to be dealt with. And they go through this and put forth as much as they possibly can, whether it's going to be MMT. And by the way, MMT hasn't necessarily been decided on at all. Many people believe that there will be a paycheck delivered to their mailbox and that's it. It's not that black and white. We need to actually sit down and look at it further because at this point it really hasn't been implemented, and so what they plan on doing and how they plan on funding it is extremely important. Negative interest rates are most likely coming. In fact, they have been implemented in many countries around the world already. We have seen that this has really largely very little impact on the actual economy also. Then we talk about helicopter money, and this one is my favorite. This is what will probably have to occur at some point. That means printing up a whole bunch of money and handing it out to individuals. Welcome to the hyperinflation. GDP growth slowdown. I just wanted to show you this here. It's the 20-year moving average because things happen time and time again. So we need to really smooth that out. And basically, since the 1970s to present, what we are seeing is that there's less growth. Even though we're printing more money than ever before, even though the stimulus measures are way bigger than they have been in history, you can see that they're actually getting less out of it. So technically, the more money they print, the less of the value that they get. And this happens to be the case here. As you can see, there's really so much evidence, and yet they continue to do this over and over again. Morgan Stanley says the economy is on recession watch as bond market flashes warning. If you want a little bit of humor, you can go down to the comments section. I foresee many comments that are suggesting that I said there's gonna be a recession and I said this and that. No. Morgan Stanley said it. Renewed trade tensions and a slump in economic data put U.S. profits and economic growth at risk. Numerous leading companies may be starting to throw in the towel on the second half rebound, something we have been expecting. Market risks have been reflected in the bond market, pointing to an unusual phenomenon in government debt yields. So just looking at the yield curve inversion, which has happened in many cases here. Of course, this happens to be the 10 and the 3, and this just shows you that over time this occurs, all right? It's a leading indicator when you get these yield curve inversions, and this happens to be one of them. If it stays persistently below this level for a 6-month period, then it is an absolute trigger, because it's not just a fluke. It doesn't just reverse. This is remaining there, and of course at this time we have to be concerned. It doesn't mean there's a recession tomorrow. It doesn't mean that it's going on right now. What it does is basically signal historically when this occurs in the near future, most likely there will be a recession. This happens to be the US cycle indicator, just showing you over the different periods here. The red is the downturn, and it looks like we are headed into that territory. You usually do not get false positives using this indicator, and you can see today we have entered into that territory. Falling interest rates are sending a warning signal to the stock market. Bond yields are sending a message about the economy, and that could mean trouble for stocks. Also, look at what's happening with the real estate as you see that this has come down, mortgage rates coming down as a result of the Fed funds rate not budging. They were going to go up. They were supposed to go up this year. Obviously, they can't do that. It's more likely to move down than up. And at this point, what we see is the reaction to that. We saw a little boost in the housing market, but then the month after this, it actually declined. And so we'll see how the numbers really keep going here, because I saw them at 4% for a mortgage rate, actually just under 4%. So that tells you can get a very cheap mortgage, and obviously that is stimulation to the real estate market. The real estate market is very important in the United States, not quite as important as it would be, for example, in Canada, where the entire economy is reliant on it at this point, but it's still very important. A lot of jobs surrounding it, whether it's in the construction fields or whether you have the materials that are involved, or it could be in the financial side, the mortgages, the banks, and so on. Jim Bear Stearns Kramer, the U.S. economy could be on the verge of a significant slowdown. I didn't say that. Jim Bear Stearns Kramer did. I think we could be on the verge of a significant slowdown in the U.S. economy if something doesn't change soon. This guy likes to flip-flop every day. You can see that. He says the economy is so strong. Next day he's saying this. But I just think it's interesting to see how they're actually admitting it in some cases, where you have big companies like Morgan Stanley are actually talking about the issues. Consumer and corporate confidence is waning. Things just don't feel right in this country. That's pretty obvious. We've seen this happening right now over the last few months. In particular, since about October, it has really started to weaken because of everything that has been piling up. The trade issues are just one. We have seen economically, everything is basically coming down. We're looking at global trade that's been falling, taking a hit. Economies around the world are suffering, and this doesn't really play well into this whole facade that everything is okay. I'm just not buying it. I'm looking into it all, and quite frankly, no matter what the shares of Amazon are currently priced at, I'm not believing that the economy is doing well. It's two very different things. In the next recession, there could be a few activities that occur, as we mentioned earlier. MMT is being proposed by many individuals out there. We need to give people money. The economy sucks. Let's give people money. I do not think that that is a solution to the problem. We need to fix it at its core. That's my opinion. I'll leave that up to you. There could be negative interest rates. I think they're going to go for it regardless. I think they'll try probably a QE round. They'll do the negative interest rates at the same time. And then when that doesn't work, then they'll go more towards the helicopter money. And I think that's really where it's ultimately going to have to go in order to support asset prices as everything deteriorates. They're going to go for it most likely, and they will destroy currencies. Ultimately, this is their plan, I believe, that they want to create a crisis to then pose as the saviors to provide the solution, and that could be some sort of global unified currency like the IMF SDR, which backs all of the other, the national currencies. I don't know how they would implement that. I have no idea what they're going to do really, but that's probably where it's heading. We'll see how it happens. When it does, I'll be here to cover it all. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a like on this video, you're supporting me, supporting this channel and the truth. There are so many other channels out there that are providing nonsense information that doesn't teach you anything, that doesn't save you time on anything. It might be entertaining, it might be interesting, but what I'm trying to do here is save you time, condense the information that I find over hours and hours of research, squish it down to hopefully about 10 minutes. So if you appreciate that, give me a thumbs up on the video, hit that subscribe button, and last but not least, if you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. Get all of the information that you need at the link in the description. Check it out if you want the audiobook that's available at themoneygps.com. The economy is looking weak. It is absolutely terrible on so many levels. You have to see this video right here. Click on it and I will see you there.